Welcome back to the Deep Dive. Today we are digging into a really fascinating one, Abercrombie & Fitch, right as they're heading into the make-or-break holiday season.
That's right. And our mission today is, pretty straightforward. We need to break down the key financials, what's going on with their two big brands, and what they're telling investors to expect.
And it's such a compelling story. I mean, this is a legacy brand that just delivered its 12th straight quarter of growth.
Exactly. While facing some pretty significant headwinds.
So let's jump right in. The headline figures, they really set a positive tone from the get-go.
They really do. We're talking record net sales for the third quarter, $1.3 billion.
Wow. And that's a 7% jump over last year?
A solid 7%. And critically, this wasn't just meeting expectations. They were at the high end of their own guidance for both sales and operating margin.
And the bottom line, the earnings per share, that was the real beat.
It was. It came in at $2.36, which was much better than a lot of folks on the street were anticipating.
That kind of performance, it just gives management so much confidence. You can see it in how they're guiding for the full year.
Totally. They're narrowing that full year sales outlook, but they're pushing it up towards the top end of the range they gave back in August. It tells you they think they can stick the landing for 2025.
And that's on top of what was already a record 2024.
It's all about execution and confidence. But to really get a sense of how they're pulling this off, we have to look under the hood. We have to dive into the margins.
Okay.
Because that is where the real fight is happening.
All right, let's unpack it. Gross margin for the quarter came in at 62.5%.
Right. And the operating margin was 12% of sales. That delivered about $155 million in operating income.
But those numbers don't tell the whole story, do they? There's some crucial context here.
The essential context is, well, it's tariffs. It's this huge anchor. Both of those margin figures had an adverse tariff impact of roughly 210 basis points.
210. So that's over 2% of sales. Just gone. Wiped out by external costs.
Gone. Before they even get started, which management then has to find a way to claw back somewhere else.
So that explains the year-over-year decline in operating margin. It was down 280 basis points, but now I see where most of that came from.
Exactly. 210 of those points were just the tariffs. The rest, that's where their strategy comes into play.
So what's happening with that other 70 basis points?
Well, they made a choice. They ramped up marketing spend by 100 basis points, which you have to do to keep the brands hot.
Okay, so that's a new cost.
It is. But they managed to partially offset that by finding leverage in their G&A expense. General and administrative stuff.
Oh, like tighter payroll?
Tighter payroll, lower incentive compensation, the controllable costs. They tightened their belt in one area to reinvest in another.
That is some impressive operational discipline right there.
It's a sign of a really healthy organization. And while they were doing all that, they were also sending a ton of capital back to shareholders.
Oh yeah, the buybacks. They repurchased $100 million worth of shares in Q3 alone.
$100 million. And that brings the total for the year up to $350 million.
Which is what percentage of the company?
Get this. Since the start of the year, they've bought back 9% of their shares outstanding.
9%. That is a serious commitment.
A huge vote of confidence in their own stock. And they're not stretching themselves thin either. They ended the quarter with over $1 billion in total liquidity.
Okay, so the financials are strong despite the pressure. The other big piece going into the holidays is always inventory. You don't want to be caught with warehouses full of the wrong stuff.
And they're not. Management's word was clean.
And the numbers back that up.
They do. Inventory costs were up 5%, but about 3% of that was just the tariffs making everything more expensive. The actual number of units, the physical close, was only up about 1%.
So inventory is basically flat. They're not over-ordered. It sounds like that read and react model is really working for them.
It's the key. And that tight inventory control leads us right into the brand performance. Because you have two very different stories playing out here with Hollister and Abercrombie.
Let's start with the one that's just on an absolute tear, Hollister.
Firing on all cylinders is an understatement. 16% net sales growth in Q3.
And the comparable sales number.
Even better. Comp sales were up an incredible 15%. And this wasn't just one thing, it was balanced. Men's, women's, Online, in-store, just strong traffic everywhere.
And because their inventory is so tight, they're actually getting better prices, right?
Exactly. Their average unit retail, or AUR, went up because they just didn't have to run as many promotions. They're selling more stuff at a better price. It's what every retailer dreams of.
And they seem to be generating real cultural buzz, too.
Oh, for sure. These collaborations they're doing are so smart. The Taco Bell partnership for Cyber Monday, hitting that whole 90s Y2K nostalgia thing.
And the college athlete deals for rivalry week. Very targeted.
Super targeted. They know exactly who their customer is and where to find them.
Okay, so now let's pivot to the other side of the house. The Abercrombie and Fitch banner. It's been more of a turnaround story.
It has. And if you just look at the surface numbers for this quarter, you might be a little worried.
Net sales were down 2%, comps down 7%.
Right. Not great. And that was mainly driven by lower AURs. But, and this is a huge but management kept stressing that the AUR decline was way less than it was in the first half of the year.
So the bleeding is slowed, the ship is turning.
The ship is definitely turning, and there are other positive signs. The customer file is growing, traffic is positive, and just like Hollister, inventory is super tight.
And the improvement was led by women's, I saw.
Yes, specifically in the cold weather stuff. And they're leaning into smart collaborations here too, like that Kimasabi collection, tapping right into that Western trend that's so popular right now.
But the goal they've set for Abercrombie for Q4, it seems, almost unbelievable.
It's ambitious, for sure. Their goal is for the Abercrombie brand to be approximately flat on net sales in the fourth quarter.
It's flat after being down 7% in comps.
And here's the kicker. They're measuring that against a record-setting Q4 from last year.
No way.
Yes. So going from a comp decline to flat against a record, that's not just an improvement. That's a massive operational victory. It proves the brand is stable.
Okay, let's zoom out a bit. How does this look on a global scale?
Well, regionally, the Americas were the leader of the pack. Comp sales up 4%.
And Europe?
Europe, or AMA as they call it, was up 2%. That was really driven by the UK, which is their biggest market over there. They've done a lot of localized marketing that seems to be paying off.
But there was some softness elsewhere in Europe.
Yeah, Germany in particular. But that's a market where they're still in the early days of rebuilding. APAC, meanwhile, is still a small business for them, down 12% in comps. But they expect that kind of volatility as they build the brand there.
And what about physical stores? Are they pulling back like so many other retailers?
Quite the opposite, actually. They are on the offensive with their stores, but in a really smart way. The plan is for about 100 new experiences this year.
Not just new stores.
Exactly. It's 60 brand new stores and 40 right sizes or remodels of existing ones. And importantly, they expect to be net store openers. The 60 new stores will more than cover the 20 or so they plan to close. It's all about fewer, better locations.
Now, I want to shift to what might be the most forward-looking part of the call, the tech offensive, specifically AI.
This is where things get really, really interesting. And I think it's where the market might be missing the story.
It's more than just buzzwords for them.
So much more. We already know they've been using AI agents for customer service to get more efficient. But this new partnership they announced, it's a game changer.
The one with PayPal and Symbio
Uh-huh.
for, what do they call it, Gentic commerce.
Generative commerce. And you need to understand what this means. Right now, if you're chatting with an AI and want to buy something, you have to leave the chat, go to a product page, add to cart, checkout.
There's friction. And every click is a chance for the customer to leave.
Exactly. This new system, which uses AI answer engines like Perplexity, lets you do the whole thing, ask about a product, choose a size, pay for it all without ever leaving the chat window.
That is unbelievably streamlined.
It's frictionless. Think about what that does for conversion rates. It turns a customer service chat from a cost center into an instant point of sale. This is how you build a real competitive advantage.
A technological moat around the customer.
Precisely.
Okay, let's bring it back to the near term then. For investors listening, what are the key numbers to watch for the rest of the year, especially with those tariffs?
All right, so for the full year, they've tightened that net sales growth guidance to a range of 6 to 7%.
And the operating margin.
Forecasted between 13 and 13.5%. And that number is honestly incredible when you see what's baked into it.
Which is what?
First, a $90 million tariff impact for the whole year. That's 170 basis points of pressure. And second, a one-time benefit from a litigation settlement, which helps by about 70 basis points.
So they're guiding that high despite absorbing that huge tariff hit.
It shows real strength. And looking at Q4 specifically, the pressure gets even more intense.
Because of the holiday volume.
Exactly. They expect a $60 million tariff impact in Q4 alone. That's 360 basis points of margin pressure.
That is immense. Is there anything helping to offset that?
There is one big tailwind. Freight costs have finally normalized, so they're expecting about 150 basis points of benefit from lower cost of goods sold. They're using the freight tailwind to fight the tariff headwind.
And what about pricing? Are they just passing all these costs on to us?
Not yet. And this is a really key strategic choice. For Q4, they're holding prices flat because they had such a strong holiday last year and they want to drive volume.
But the price hikes are coming.
They are. They signaled very clearly that targeted price increases are planned for the spring collection, which starts arriving in late December and January.
That is some strategic patience right there. And it sets us up perfectly for our final segment.
Let's do it.
All right. This is the part of the show where we have to remind you, we are not financial advisors. This is not financial advice. Nothing we say is a solicitation to buy or sell anything.
But based purely on the operational data we've just discussed, we love to sketch out an outrageous but plausible trade idea for you to think about.
And you think there's one here?
I really do. The thesis is simple. Go long Abercrombie & Fitch. My conviction is that the market is completely underpricing their operational resilience and, more importantly, their technology pivot.
Okay, lay out the pitch. What's the target?
The pitch is to initiate a long position, and you're targeting a 15 to 20% move by the second quarter of 2026.
And the logic behind that.
It's multi-layered. First, Hollister's 15% comp growth proves that their read and react model is a repeatable, profitable engine. Second, the turnaround at the A&F banner is real. Hitting flat against a record Q4 proves it's stabilized and ready to contribute again.
So the core business is solid, and the tech is the accelerator.
The tech is the turbocharger. That generative commerce partnership with Perplexity and PayPal isn't some gimmick. It's a fundamental change to their business model that will drive margins and customer loyalty way faster than the market expects.
So you're saying the tariffs are just a temporary problem?
They're turning a $90 million headwind into a temporary cost of doing business while they build a permanent technological advantage. This stock is, I think, a true value play hiding in plain sight as a high multiple apparel name.
A very compelling case. So to wrap it all up, the key takeaways for you are the explosive double-digit growth at Hollister, the crucial stabilization at Abercrombie, and this incredibly sophisticated strategy using AI to fight off massive macro pressures.
It's really a masterclass in management. They're using every tool at their disposal, internal efficiency, technology, to build a stronger company for the long term.
A fascinating look at how a legacy brand is fighting to define its own future. Thanks for tuning into this deep dive. We'll see you next time.